Hi there everyone, and welcome to our end of July edition of On Track. I'm Rob McGregor and I'm recording this on the 24th of August 2020, which ironically is exactly 5 months after the market bottom post-COVID. So we're about 6 months into this interesting episode of life. As usual, I'm going to dive deep into what's happening in the news, the markets, etc. So firstly, a warning, general advice warning. As always, these videos are designed for clients of McGregor Wealth Management, particularly those that utilise the care investment process. If you're not a client of McGregor Wealth Management, feel free to watch this and take it in, but you should not act on anything in this presentation without getting advice that's particular to your own circumstances. So in today's video, we're going to have a look at the latest economic news, and it's kind of more of the same at the moment. We're going to put it into context. I'm going to dive deep in a couple of areas. There's a lot of talk about how the US market has run pretty hard. So I'm going to have a look at the winners and the losers in that market. I'm going to show how it's been driven by the big tech companies and why. And we're going to look under the bonnet at some of the portfolios to see some of the stocks you hold, and doing all that with the context of the importance of what I call the boring stuff, and more about that later, and an update on each of the markets and putting it all in perspective. So let's dive into the news highlights, and it's a bit scary. I hardly have to change this at all at the moment. We've sort of got second waves, third waves. We've seen in Australia the Victorian, Melbourne in particular, second wave go up, and then cap off and then be slowly coming down. But with each wave becomes a bit of paranoia about, are we going to have to do this every time? And it's very hard to tell. We've seen a little bit of more cases in New South Wales, but nothing out of control. And just in the last few days, we saw one outbreak in Queensland, but it looks like that'll get under control pretty quickly, but who knows? The economic news continues to be reasonably bad, mainly because that's historical, and yes, we're in a recession, and there's a lot of trying to work out how long that recession will go for. Last month they extended JobKeeper to the end of March 21. That's causing a lot of businesses to reevaluate where they're at. For someone to be eligible for JobKeeper, their September quarter revenue, that's revenue not profit, has to be down 30% to the same quarter last year. There's going to be I'm seeing a lot of businesses that are going to be a bit short on that, and it's over the quarter at the moment. When JobKeeper started, it was just for the month. So it's going to be interesting to see whether people manipulate figures to qualify for JobKeeper. But there's also a bit of a black hole for many businesses if they're down by say 20%, but then they stop getting JobKeeper. That may mean they're a lot worse off. But ultimately, we've got to slowly get back to the real world, and that's what they're trying to do. We've got increasingly no signs of crowds or travel. We've seen modest crowds at football in Queensland and in all the other states, not counting Victoria in particular, but still very, very spaced out, and no real overseas travel on the horizon. We are seeing some other countries starting to open up. But for us as Australians, we're actually not allowed to leave the country. I saw one statistic during the month which said 75% of people applying to leave Australia are being knocked back. It's quite amazing that we're letting government stop us from leaving the country. Who would have thought we would let our civil liberties be eroded that much? But it is understandable in this crazy pandemic world that we're in. The US election race, the Democrats kicked off their run, I suppose, with the nomination of the vice presidential candidate and their convention, which was all online, a first. They seem to have one topic and one topic only. Let's beat Trump. Joe Biden's already said when he gets in, he's gonna solve coronavirus straight away. That's a big, bold promise. I wish him luck, but we're going to see some craziness. It's going to be fascinating to watch this. There's the whole question about whether Trump will accept the result, and that's mainly because of the high reliance on postal votes. We're seeing in elections all around the world low turnouts. People just do not want to go and stand in a queue and go into booths that other people have been in while the governments are telling to social distance and lock down. That creates a significant issue for democratic elections, and as Trump's pointed out, he's worried that postal votes can be manipulated. He misses the obvious point, by the way, that either side of politics can manipulate those things, so it won't necessarily favour one or the other. But we're going to see some craziness, is my point here. I make no prediction on that election result. The polls say Biden. We'll wait and see. I don't have any major concerns either way. I think there's some positives for both. They're different, very different positives. I think Biden and the Democrats bring an economic unknown, but they bring stability to leadership. I think more Trump brings reasonable economic stability, but craziness on the leadership. So there's, it's not a great choice. I feel like we've got much better politicians and governments in Australia at the moment. I know some may disagree with that. Anyway, I don't want to pause on that. I'm going to do a quick summary at the start, as I did last month. So the portfolios were all up for the month. The month of July was a positive month, with high growth being the share market up about 1%. So that'd be about 12 to 15% annualized. That helps bring back some of the negatives, particularly of the last 6 months. So if you see the 6-month column, you'll see mainly negative, except for the reserves portfolio as is designed. And then you'll slowly see the 5-year it's picking up. The 5-year returns for the high growth are slightly above the returns for conservative. You only see this when we're right close to a downturn. The long-term target's shown there on the right, and we're slightly below that for the 5 years at the moment, but that's perfectly understandable given we're in a pandemic, and we should see that come back nicely. Now, just to put in perspective, I've thrown in a chart file on this. So you'll see me here say, for a balanced portfolio, say 4 plus CPI is the target. We're about 4.78% over 5 years at the moment, so not too far away. And CPI is probably sub 1% at the moment, and call it 1.5 to 2 historically over the last 5 years. I always like to put that in context. Here's a really long-term picture of the US market. And what I like about this chart is it's got growth portfolios, balanced portfolios. And you can see, balanced portfolios since 1925 have averaged inflation, plus, what do we got for inflation here? Inflation at just around 3, balanced portfolios pre-pandemic at about 8%, so about inflation plus 5. Now that's over 100 years pretty much. It includes 2 world wars, numerous other wars such as Vietnam, etc. It includes the Great Depression, lots of the oil price rise, the GFC. So during the good, the bad and the ugly, a balanced portfolio, inflation plus 5. Take away 1% for reasonable costs of managing investments, etc. and bad inflation plus 4. Now, you can see some interesting insights here. If you look at the downturns, so that's 1 year periods, rolling 1 year periods, where the return was less than 0. Sort of it's less than 20%, or bang on about 20%. And returns that are less than minus 10% are only 5% of all periods of time. So, and look at this little chart within the chart in the top left-hand corner here. So all these things shows the run of bull markets broken up by the run of bear markets. And if you look at that visually, you can see how much more often the market is running well versus the downturns, even though the media makes us feel like the downturns are just as common. It's crazy not to be a long-term investor when you look at these sort of charts. So let me dive into the context. We know the market goes through cycles. So it goes through a boom, which is always followed by a bust, but most of the time it's in what we call the wall of worry. And we see that time and time again in the charts. Now we aim to rate where markets are at in terms of whether they're fair value, sort of cheap, expensive, all within wall of worry, or whether they're at one of those extremes, FOMO or fear. And you don't see them often, only every 10 to 20 years. Now I would want to make a point that this downturn was not part of a normal cycle. but rather caused by a health crisis. So every other downturn we've had in the last 100 years, and when I say downturn, I'm talking about a bear market, the ones shown here, the top 8 previously, where we went down by more than 20%, every single one of those came after a boom. So they're part of the cycle of boom, bust, wall of worry. This is the first one we've had in the last 100 years where the downturn was caused by a health crisis. Now that's part of the reason it's rebounded so quickly, because it wasn't part of a cycle that was overdone in terms of being part of a boom. So part of what's happened here is we've had a quick recovery, and now we're about 10% lower because we're uncertain about sort of what's going to happen in the world, 10 to 20% lower depending on the markets, and we'll wait to see what happens. We rate the market as fair across all sectors at the moment on average for our diversified portfolios. I'll talk about individual portfolios as always. Now we say that with a degree of not certainty, because there are still a lot of possibilities, as I went through last month, on what could cause the market to go up strongly or down. But I do believe the balances are weighed in terms of the usual probability that the market's 75% more likely to go up than go down over the next 1 year and more. So I'm going to dive into today our framework. Let me just make these slides larger. So this is the 4 pillars of our investment strategy. Today I want to look under the bonnet at one of the what a lot of people think is the boring things, but is the key to long-term wealth creation for your nest egg portfolios, and that's modern portfolio theory. So I'm going to lift the bonnet on that, just one of those pillars. Just a reminder, the biggest danger at the moment is a short-term focus. I cannot believe there's almost no story in the world at the moment that's not about COVID. There's a lot of good things happening, but we're so focused on the short term. It is such a big issue that most people are scared to invest for the long term, even when they look at those big pictures and know that this is a episode that's not, we've had these before, albeit a long time ago, and capitalism, which drives the share market, is incredibly innovative, which causes markets to go up. I want to dive into the US share market as one of my main topics today. The US share market has come up really quickly, and you'll see that when we get to the US numbers, but you're hearing people talk about how the US is back to its pre-COVID levels. How can that be? That's crazy. Surely we're at valuations that are too high. Surely it's got to fall. But the reality is there's multiple stories within the US market. And this was a chart that Alan Kohler highlighted on the ABC News a week or so ago, and we scraped it off his Twitter feed. But it shows what he termed the S&P 5. So that's just the 5 biggest companies in the US that happen to be 5 of the biggest companies in the world. Not the 5 biggest, but 5 of the biggest. So that's Apple, Amazon, Alphabet, which is Google, Facebook, and Microsoft. And you can see since 2015, their performance is up 4-fold. So if you'd invested in those companies, you'd have 4 times your money. Now, the rest of the market is only up 30%. And if you look at the extreme right of the chart, you can see the downturn. Now, ironically, those big companies dropped a fair bit, but they've recovered way more than where they were at the start of the downturn. Whereas the rest of the US market, that's the other 495 out of those top 500 companies, they're hardly up at all. They're actually below where they were. And they're more in line with the Australian market, which is still down 9 or 10%. So let's break that down into some subsectors. So this is the sectors or group that make up the share markets in the US. And let's start with the ugly. So the sectors that have copped it the worst, airlines down 50%. So that's their total return for 2020 so far. So for the calendar 2020, down 51%. Hotels, resorts, and cruise lines also down 50%. So the travel industry has done it particularly tough. Energy, ironically, down 40%. Financials down 22%. But let's have a look at some of the areas that are up, because the US market is up, but you can see some big downs there. So we've got those big 5, and they fall part of information technology, Apple and Microsoft. communication services, Google and Facebook, and Amazon, consumer discretionary spending. And you'll note the other one that's the big up in all of that is retailing. So particularly, we've seen this in Australia too, particularly the supermarkets, particularly essential retailing, it's up 30%. Now, there's a lot of discretionary retailing that is down, but that, in Australia, Coles and Woolies, Bunnings, all up 30%, same sort of numbers. So we're seeing a concentration of what's gone up here. It's not necessarily a bad thing. Now, some people say, what about Apple, Microsoft, Google? Have they gone up too much? Now, that, as always, depends, but they've gone up on the back of increased revenue and increased profits. So this is no tech bubble like in the early part of the century, around 99 to 2001, when tech giants went up off the base of not a lot of revenue and no profits. These guys are making a fortune. You think about where the world's gone to. Where are we spending our time? We're spending our time online. So that's Apple and Microsoft, on our phones, on our computers. We're spending our time on Facebook. Amazon employed an extra 100,000 people in the last quarter. 100,000 people that one company employed. And they're not employing them in the tech space. They're not computer programmers. They're employing them in logistics centers, in warehouses, because Amazon is a retail company. It's just people buy online. We've got Amazon in Australia. You can buy online, and they have distribution centers set up all around Australia. So they've added 100,000 people worldwide, so that they've employed, which is a good story. It's a tougher story for smaller businesses that don't have online capability, and you'll tend to find the businesses that have done well are local, or they've got online capability. And there's a lot of people businesses in between, particularly things like fashion and discretionary retail that haven't done quite so well. So our take, and the investment committee, the Care Investment Committee has spent a lot of time on this. Our take is we still think US markets are fair. Some of these companies have got a little bit expensive, but companies that are growing strongly can stay expensive for a long, long time. And if the world continues as it is for a little while, and if some of the trends that we've seen, trend towards online shopping, trend towards more online delivery of services as well, if those trends continue beyond COVID, we will see these companies continue to make good money. It's interesting, during this crisis, we immediately switched to 100% Zoom meetings, which we did for, I guess, about the first 3 months. And then we've slowly added face-to-face meetings where people are comfortable and they're local. But for a lot of our business clients and working clients, they're still preferring Zoom meetings, partly because that's their work at the moment. And with mastering the technology, the Zoom meetings are highly effective. And it doesn't have to be Zoom, by the way. Zoom's just one brand. You've got Microsoft Teams. The other day I had 5 online meetings. One of them was Skype. One of them was Microsoft Teams. One of them was a company called GoToMeeting. The other was Zoom. So there's so many ways that people can do online at the moment, and the money on that has become incredible. So while you might hear the media say the US share market is at record levels and how can that be sustained, it's partly because of the tech drive of the big 5. Now, it's not just the big 5, by the way. You're going to see that when I look under the bonnet at the other portfolios. So let me now have a quick look at the boring stuff before I get to portfolios. So it's what we call modern portfolio theory. And modern portfolio theory was developed, started in the 50s and through the 60s and 70s. One of the leaders of it was a guy the guy they called Harry Markowitz. So Harry Markowitz would eventually get, he and his colleagues, a Nobel Prize for economics for their development of modern portfolio theory. And in a nutshell, modern portfolio theory says you get more return with less risk when you have a diversified portfolio that's filled with things that don't always correlate to each other. Now let me explain what I mean by that. So the first part of modern portfolio theory is asset allocation. So on the screen I have an asset allocation of a typical balanced investor, and I've just used a small sample portfolio here that shows how spread that client is between Australian shares, international shares, fixed income, property. So a spread of things is asset allocation. So the exact percentages is what makes up our asset allocation. The top right-hand corner is the asset allocation of our active portfolio. and the bottom right-hand corner here is the asset allocation of our balanced portfolio. Now, these can change from time to time, but the first point is they give you an incredible amount of diversification. So literally, if you're in these or their other portfolios, the growth portfolios, etc., you literally have exposure to thousands of companies around the world and literally thousands of government and corporate bonds. So no one company will ever make or break your portfolio, which is one of the important benefits of diversification. So the third plank there is rebalancing. So what rebalancing is, it means you bring back the weightings within here. So you can see here in the active portfolio, they're all around 20% plus or minus. Now the target weighting for these guys is just under 20% because we have to carry about that 1% cash. So every time they get, we rebalance on a regular basis. That can either be every quarter if we haven't rebalanced. That could be if a boundary's hit. So if any one of these gets to 22% or to 18%, that will trigger an automatic rebalance. Or it can be a tactical rebalance. Occasionally something will get to 21 and we'll say, look, we think it's probably worth rebalancing now to take advantage of this opportunity, because things do come back to average over time. And by rebalancing, the academic research shows that rebalancing adds between a quarter and 1%. So let's settle on 0.5%. And what that does is it effectively pays for your investment management fees. So that means you're getting, when we look at those returns I talked about before, the index at inflation plus 4 to 5%. If you've got some of those costs taken care of by smart rebalancing, then that allows you to share in those index returns for most of those returns. The balanced portfolio. So these portfolios we've rebalanced a handful of times in the last year, and very actively during the COVID downturn. So when the market dropped dramatically, that triggered rebalancing, and we had, as you'll see, gold going up, for instance, and the others going down. So when something goes up, all of a sudden it's worth more in the portfolio. So we sell a little bit of that, and we're always selling at highs and buying at lows when you rebalance. And that's why it's a strategy that always works. A simple market strategy is buy low, sell high. That's how you make money. So rebalancing always enforces that, and it stops us from getting out of whack to any one sector. So that's my quick deep dive into modern portfolio theory. It's just doing things smartly and properly. And when done well, it gives you confidence that you're going to get those long-term targets that we talk about. So let's now move into the update on the individual markets. And for this month, I'm looking under the bonnet at the securities, at the companies that make up these indexes as well. So we were up just about 0.6% for the Aussie share market in July. We're still down 10% for the year, but you can see those long-term averages at around that inflation plus 6 or 7, which is normal over time. You see the top 10 holdings here, dominated by big companies, and you'll see here that the top 10 of the Australian market, and this is the ASX 200, makes up, actually, that's the Vanguard Australian Share Fund, so that's the ASX 300. So the top 10 companies make up 42%. So in Australia, we have a massive concentration on our big companies. So that's the big four banks who are all there: Commonwealth Bank, Westpac, National Bank, ANZ. Our two retailers, Coles and Woolies, represented through Wesfarmers and Woolworths. Actually, Wesfarmers read Bunnings now. Coles runs its own. Coles was owned by Wesfarmers for a while, but now a separate flow. So that's the Bunnings factor in Wesfarmers. Wesfarmers does own a lot of other things as well, but the Bunnings is huge. And then you got the two big materials company. Look at that, it's only one now. Rio Tinto's dropped outside the top 10, so it's just BHP. CSL, our massively growing company, and I think by the end of August, CSL will probably be the biggest company in Australia. It's had some very good profit results. The banks are in a slow growth world where pretty much we're just getting dividends, albeit good dividends. So high concentration there. Now the 1 year chart shows that down 10% with that amazingly steep drop we had at the start of COVID, a reasonably rapid rebound, and then we're sort of wobbling sideways. We're firmly in the wall of worry. We're calling that fair value. You'll see for the 5-year return, and I believe long-term investing starts with at least a 5-year outlook. So someone who'd invested 5 years ago is still well ahead. They've received a dividend plus they've had the growth shown on here. These charts do not include dividends. The Australian market would have paid a dividend of about 4% before tax and nearly 5.5% with the franking credits on top of some modest growth. So in the last 5 years, even though we've gone through this crisis, you'd still be ahead, and no reason to expect otherwise for the next 5 years. So for US shares, and keep in mind this is in Australian dollars, US shares are actually up for the year in Australian dollars, and the US market is up, and that's why I'm talking today about let's look under the bonnet at the US shares, and we see it was driven by growth in those top 5 companies. Well, let's have a look under the bonnet here. So the top 10 holdings in the Vanguard US Total Share Market Fund, which is the one we hold in our core portfolio, there they are, the top 5: Apple, Microsoft, Amazon, Google, and Facebook. And the top 10 here make up 24% of the US market. That's as high as I've ever seen it. The US traditionally hasn't had the same level of concentration, but we're now seeing what's called the network effect. If you now become a dominant player in a sector, like Apple is with phones, or even the top 2, because you're going to see Samsung come up in one of the charts in a minute, and you get that all around the globe, it's very hard for people to break in. Doesn't mean they can't, but you have what's called a network effect because you just have sheer numbers that make up your network. Microsoft have it. Most people have some form of Microsoft products, whether it's Microsoft Word, Excel, whether it's Microsoft-based computers through Windows, but they also own lots of other companies now as well, like Skype and other companies. So they have a massive presence on your devices. Amazon, the global retailer, and of course Google and Facebook at probably almost the biggest media companies these days. When I say media companies, that's where people go to advertise. You'll see ads on your Facebook feed, you'll see ads on Google, and more is where businesses are spending their money on online advertising, which is going to continue to drive their revenue. Interesting. So when you own VTS, as you do in the care portfolios, you own these top 10 companies, so you have a presence there. So let's jump to US small caps. So when I say small caps, these are pretty big companies, but they're companies outside. This is what make up the S&P 600. So it's the companies outside the top 100. So they're fairly solid companies. There's a lot of them in the US. One of the reasons we like this particular index and this particular exchange traded fund is because you get a good representation of the US economy. In the last 10 years, this has had a 13% return. It's come back in the last few years. It's suffered in a similar way that the Australian market has done, and it's down about 12% for the year in Australian dollars. It's up for the month. And when you look under the bonnet, I don't know about you, but none of those companies are household names. So these are just big companies. There's manufacturing, obviously, lithium motors. I don't know any of those companies, but we get a really good cross-representation. And this sector grows quicker than large caps historically, but it's more volatile. And we're seeing that at the moment. We're actually getting the growth come from the large caps. The good thing about diversification is we own both of them. Global leaders, so this is IOO. This sits in the active portfolio, and it's the top 100 companies in the world. And you'll see it's up 10% for the year. So we've got the old school economy down about 10%, represented by the Aussie market and the US small caps. But we've got the high-tech world. And when you look at the leaders here under the bonnet, once again, you've got Apple, Microsoft, Amazon, Google, Johnson & Johnson sneak in there. You've got Samsung sneaking in there too, so another tech company which makes the Samsung phones. And the phone market is absolutely dominated between Apple and Samsung, with Microsoft having a bit of a share, and Google a bit of a share there as well. So pretty much every device in the world is covered in that top 10. So we've seen good returns for this. Look at that, 14% for the last 3 years, 10% for the last 5 years. Incredibly important to have these in there. But you're seeing Apple now show up in a couple of areas, and Microsoft and Amazon and Google. So you've got them in reasonable proportions in your portfolios. Emerging markets is fascinating, and this month emerging markets was up 4%. You think, wow, why is China, China, Vietnam, Brazil, these companies up that much? And partly when you look under the bonnet, you'll see some massive companies that just by accident happen to be in those emerging market countries. Alibaba is effectively China's, Alibaba and Tencent are massive Chinese companies. Taiwan, semiconductor manufacturer, they make chips for a lot of the computers around the world. They're one of Intel's biggest competitors. You got Samsung that we just talked about, phone manufacturer. So the top 5 here, and we've now got these top 10 make up 30% of the emerging markets. Those top 5 are all of these top 10, but particularly the top 5 are what I'd call global companies. Where they live is an accident of where they started. Once upon a time, for instance, the top mobile phone company in the world was Nokia, that just happened to be in Finland. So all of a sudden, Finland was represented in a higher weight in global share markets. So we're seeing that at the moment with something like Samsung, South Korea, we got Taiwan in there, etc. So emerging markets, which had a bit of a bad run for the last little while, have had a catch up in the last few months, but it's predominantly the same effect on those large tech companies. So once again, that's why diversification is so important. Gold we have in the portfolios to counterbalance volatility, and you can see here why in the story of the charts. So gold was bouncing along, doing not much at all for the previous 3 or 4 years, and then in the last year it's up 31%. So up 26% in the last year, 31% over the last 3 years, but all of that growth has come in about the last 15 months. So before that it was flat. So that's helped the active portfolio deliver a good positive return while other growth portfolios are down, and it helps stabilize those portfolios. Once again, pointing out one of those boring things, diversification, and how important that is. So summing all that up into those things, you'll see there the active portfolio is actually up 3.3% for the year, and that's at a time where a pure high growth portfolio is down about 7%. When you put all the care components together, our high growth is down about 5% for the year. Our retirees have enough reserves to get them through a crisis, and those reserves are also positive, doing what they need to do. So we're very comfortable with the returns. We don't love negative returns, but they're not too bad given the extent of the crisis, and we do believe there's plenty of upside to come, as always, in the share markets. So let me jump to property before I wrap up. We're starting to see a bit more redding in property, but the numbers are small. So when you look at these monthly downturns across the capital cities, both in houses and units, they're down about 1%. When you look at the 12 months, and we're to the end of July here, Sydney and Melbourne are still up 8 and 12% for the last 12 months. So even with 1% over the last few months, they might be down 3 or 4, but they're still up over 12 months. So we haven't seen a substantial drop in property prices. Property prices may drop post the banks being nice to people. People are still on their bank repayment holidays, some people, not everyone. You had to ask for it to get it. So that's helped properties not be forced onto the market. But I do know a lot of people sitting waiting to buy. There's been a lot of incentive for first-time buyers, for renovation, which is helping hold up the property market. And with interest rates incredibly low, it makes all property much more affordable. There may be an issue down the track if interest rates return to somewhat higher levels, but the consensus seems to be, and it always scares me a little bit when everyone agrees, is that interest rates are going to be low for longer. And certainly there's a cycle there that I'm going to talk about in the next few months, with low interest rates and what that means. But there's a lot of positives out of low interest rates. One of them is it makes property more affordable, and it makes property more profitable when you've got low mortgage rates. So that's put a floor under the property market. Our friends at Heron Todd White, we've had a bit of a quick cycle. So Melbourne and Sydney are in a declining market, and you'll see that there at that part of the property clock. And the property clock, once again, it's just an analogy about how the property market works. It's not a complete prediction, and sometimes a whole cycle of this can take 20 years, and sometimes it can take 2 years. And they can be different in different regions, but it just helps to tell us, depending on your part of the world, where you are. As an example, they've got the Sunshine Coast rising and approaching the peak. But I know from talking to lots of agents and lots of investors on the coast, our market is rock solid and running well without getting to the crazy bits yet. And I think a lot of people are saying, well, in a lockdown world, where do you want to live? And you'll see some of those lifestyle properties doing quite well at the moment. So some interesting points there. For clients, we're quite comfortable for those that are suitable for property investments to be buying properties with caution and with plenty of room up their sleeve. We do probably have a preference for Southeast Queensland in very ordinary average properties. The two things that drive property prices in the long run are population growth and economic growth. We're going to see both of those pause for a while. So we're probably going to see property prices go sideways for a while. But that's at the national average, and you've got suburb-specific, city-specific, and state-specific stories going on as well. So you're going to see some areas, particularly those areas that would be nice for people to work from if they're working from home, probably do better than, say, city-based units at the moment. That's the unit market. You can see Melbourne and Sydney declining there as we would expect. And it's interesting. Do not read anything into these. If you're going to buy an investment property, as always, we'd sit down and work out what suits your plan. And it's predominantly those that are still working as opposed to retirees. Retirees, the decision is more about if I'm going to sell, and there's no reason you ever have to sell a good property, but if I am going to sell, are we in a reasonable time to sell, or might there be better times? So let me wrap up with our last slide, which reinforced the process, which I've updated slightly, but not much. But all investments are best done as part of a long-term plan. That plan is based on your goals, which are individual and personal to you, and based on who and what's important in your world, and what sort of life you want to live during retirement, and what sort of legacy you want to leave. The portfolios are then designed to meet those goals. We take a long-term view because we know that long-term view wins in the long run. The boring stuff we dove deep on today: diversification, asset allocation, and for us also that the other one there is liquidity, and we do that through the reserves process. And the exposure we want to markets is about 70% for us in low-cost index for most of those growth markets, because we know we can lock in those returns. Look at some of the divergence in those returns we looked at today in the US sector, from travel companies to tech companies. If your portfolio wasn't diversified, and we get that through index, then you've got to be making tactical decisions about, travel, Flight Centre's down so much, do I buy it, sell it? We don't have to make those decisions because they're being made all the time by the managers, the Vanguards, the iShares, based on the market weighting. So that means we can enjoy that long-term growth without worrying about detailed tactical decisions. We protect against short-term volatility for our retirees with holding enough reserves to get them through a crisis, and for our clients who are building their wealth through dollar cost averaging in the share market, that just means buying every month. We rebalance regularly, and as I said, that adds to the portfolio return. And we do that rebalancing at two levels. You've seen it done as part of the investment committee in each of those portfolios, but we rebalance your weighting between the portfolios when we sit down to do your annual reviews, and we only top up reserves when it's appropriate, or we schedule it to be done at a more appropriate time. Both those things which add value. And I'll finish as always with there's only 3 ways to lose money when you invest in the share market, and a big warning not to do them. Easy to say, hard to do. The first is panic and sell, and congratulations to my client base. We have had 0 panickers during this. We like to think we've helped you not do that. That's meant you've enjoyed the recovery. The other way is when people have to sell. We haven't had one client who's had to sell during this downturn because they've all had sufficient reserves and a reasonable plan. So by avoiding those two, it means you never have to lock in the losses. And the third is if you've not properly diversified. And as you've seen today, our portfolios are incredibly diversified. When you tick off all those things, and when the market resumes its long-term pattern, as it always has and always will, you'll win. So if you look after those things, and if you've got your investing based on a plan, you will win. Thank you for spending time with us again. We recognise your time's valuable. We hope this gives you some comfort in what's happening in the world and allows you to get on with life and not be focused too much on whatever's happening in the media. Till next time we speak, wish you all the best. Rob McGregor signing out.